And that should have created massive fear. And somehow we're at all-time highs. I mean, it's unbelievable, right? We just keep climbing, you said it earlier, climbing the walls of worry.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. In this episode, the advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt. Today I'm joined by Eli Freeman.
Hello.
And John Markfeld.
Good morning.
And we've got a lot to talk about. Market's doing some crazy stuff, good stuff. It's been an interesting 6 months. So first half of the year. So we got a lot to get into, but anything fun you guys want to pop it off with?
Well, I mean, last week was quite awesome. You were in Colorado doing an adventure of a lifetime in an RV with your family. I'm just glad you're back in one piece, to be quite honest. And then we were in Banff, Canada, which was the most beautiful places I've ever been. It was unbelievable. And one of my best memories was playing golf with Eli and Lee and David. And it was just awesome. We had an awesome little, kind of break away from the heat and the.
Last week was kind of like the company vacation week or whatever.
Yeah.
Like we had a lot of people. We had some staff down in Florida. We were in Colorado. It was like we were kind of scattered all over.
It's summertime.
Yeah.
And of course, it was John's favorite part because he just whooped us in golf. I mean,
actually, I didn't whip us. He's gonna catch me real quick.
Yeah.
He's like trying.
Yeah, he's like spending money on lessons to do that.
It's not work.
Every time he I know this is a podcast, but every time he hit a bad shot, he's like, I hate golf. Because that's what practice does to you. Get your expectations get way too high.
Yeah.
And then
once
every
you start
bad shot,
carrying, it
you
gets
start
harder.
carrying and you actually practice and you think, it's just harder. The fall is harder. That's all I would say. All right.
No, last week was a fun week. It was good to be back in the office on Monday.
And the market reached all-time highs.
And the market reached all-time highs. So, man, the first 6 months of this year, right? We started the year at a high. Mm-hmm. It kind of continued to rally the first couple weeks of the year. And then we started to see some volatility. Let me see. The market peaked, what was it? Like January.
It was end of January somewhere, and then it fell to the bottom in the end of April. Mm-hmm. And then since then, Eli, you've got some good stats.
Yeah, so there's a chart. It's a tweet by Mike Zaccardi, who's a CFA, a chartered financial analyst, and he shows the S&P dropped 15%, and from that 15% drop, we just experienced the fastest recovery from a 15% drop ever in market history.
Wow.
So we had really steep volatility. There was another chart that I'm going to butcher, but we've also seen the fastest drop in volatility. So volatility was so high.
Yeah.
There was so much going on in the market, and now it's slowed down so drastically that we had one of the fastest drops in volatility as well.
Yeah, we saw. Yeah. I mean, we saw the VIX in April.
Oh, spike.
Yeah, I mean the VIX was. Yeah, we saw a huge spike, and that was kind of where you definitely saw some legitimate fear in the market. Mm-hmm. But it was like just a blip.
Yeah, for those of you who don't know what the VIX is the index or something that tracks showing how much volatility is in the market. So how fast are the markets moving up and or down at that moment.
Yeah. Some people refer to it kind of as like the fear index. Like if the VIX really, really spikes, then it's like there's actually some fear and panic of people worried the market's going to, materially decline. But it's come back very strong ever since, so we're at all-time highs.
Let's think about this all-time high. I want you guys to think about this for a second. Trump gets elected, right? It's a massive 180-degree change from the previous administration. Creates some fear, right? It can create fear in half the country, right? Then you have the tariff fears, the tariff talks, the tariff fears, which are real.
And that created fear in more than half of the country.
Yeah. Oh, yeah. Then you have
just the unknown.
The Israeli overnight attack of Iran that created, should have created fear, right? I mean, it did. Then you have U.S. getting involved in that very war, if you will, and that should have created massive fear. And somehow we're at all-time highs. I mean, it's unbelievable,
Yeah.
right? We just keep climbing, you said it earlier, climbing the walls of worry.
Yeah,
Right,
that's
just-
what the market. I mean, historically, it's like that's what the market does. It's like when
exactly.
you think you should be most fearful, the market historically continues to grind higher. And you know, we were talking about before. It's like the market rarely does what you think it's going to do, especially like when you think it's going to happen.
Yeah.
Right. And you know, I think. There are specific events that have happened in all of our lifetimes that I think they're hard for us to forget, right? We hang on to them. And so John, being the elder statesman in the room, you've lived through and were an advisor through, a couple big events.
9/11 was, I still remember vividly the second plane live on air hitting the building. I remember that vividly. And I mean, how we recovered for that is unbelievable, but we did.
Yeah, and
the financial crisis.
You almost
on
find
on.
yourself, I think, those moments in time, depending on when they happen in your career. The Compound of Friends, they were talking about this the other day. It's like almost like ingrained, and it's hard to like forget those. And you almost you're kind of like setting and waiting for the next one. And every time something starts to happen, like you're like, oh, this is the next X, whatever that event or situation is for you. And especially I think if that happened like early in your career, and it kind of sets, I came out of, school and started in the industry, kind of not long after the 2008 financial crisis. And I think part of that, like part of the reason that I'm maybe not as optimistic as Eli sometimes is because of that, because it's like, oh, well, is this the next one? But then you look back in like our entire history, like there's only been a handful of those types of events, And so anyway, I think the long and short is, you have to be careful to not let your emotions and your personal experience like set your market predictions. And you have to set systems in place and have processes, which we're going to get into, of when you need to make adjustments and why. And because if you react, like that's most likely going to be because of your personal experience and your feelings, not because there's an actual like reason or logic behind it.
And it's also worth noting, whenever you listen to media and the news is telling you about things that you should be fearful for, most of that is not the things that you really should be fearful for.
100%.
If you look back at the things that have significantly impacted the market, it's things that are not predictable and are not foundational to something that just a news article writer can find and come up with.
Right.
So if you're going to be fearful, you have to be fearful about the things that you have absolutely no control over.
Yeah.
Well, and you can't do anything with that.
Yeah.
The market itself, like there's overvaluations and undervaluations, right? So 2008 financial crisis was an overvaluation, collapse of the market, and then we were severely undervalued, right? The stocks were not priced correctly when it hit the bottom. The market comes back, we get to valuation. When under Trump's presidency, when the Dow hit 37,000 in his presidency, it was the first time the Dow hit 37,000, right? We were way overvalued on the stock market. It was way overvalued. When it fell down to 37,000 recently, we were actually in value, right? The prices of the stock valuations had caught up to the price. Does that make sense? Mm-hmm. So like it's an ever flowing thing. So even if we're overvalued, undervalued, it could correct itself.
Whenever John references the Dow, I feel like it's like someone referencing like the Farmer's Almanac or something, like trying to predict the weather.
It's the way we used to do this. I know S&P 500 is the right way to talk. Go back to 2008, that financial crisis that you referenced, about 30% of advisors in our business quit the business in 2008, 2009. It was that traumatic of an event, and we have not had something like that. COVID doesn't even come close. 2022 is a laugh compared to that. We have not come close to that. The one thing that I do take from all this is that in 2008, people lost a lot of money, 54% from top to bottom. But the problem was not that the market went down 54%. It's that people that didn't need to lose, like people in retirement ages or close to retirement ages, lost 54%. They should have never been 100% in the market.
Not everyone was devastated by the 2008
if you were
financial
allocated
crisis.
correctly, and
if you were allocated correctly or avoided making unnecessary, unwarranted changes,
Yeah.
then you got through it just fine.
But I say, like, if you're getting ready to retire or you're in retirement and the market's at an all-time high, it's a great time. You were talking about this with a client earlier this week. You were talking about rebalancing, looking at your portfolio, making sure you're in the right spots. It's not a bad time to do all that stuff when you're at all-time highs. It's not a time that you sell because you get worried it's
Right.
not going to keep going, because it very well could keep going.
You opportunistically just make the previously agreed upon adjustments that you were
Exactly.
already scheduled and planned to make. You're just doing it, at a time where it's like, hey, market's at an all-time high. It makes sense to maybe rebound. So Eli,
Yeah.
some thoughts on, if we're talking about, we're kind of rambling, but the market, what it's done the first 6 months of the year, but then moving that conversation into like how and when should you make adjustments to your portfolio?
So we were prepping for this podcast thinking, okay, what is a timely thing to talk about? And something that we hear consistently as the market reaches all-time highs, a lot of times that can create the same fear in clients or in people who are investing as the market selling off.
Sure.
Because there's this internal fear that now that we're at all-time highs, it's going to sell off again.
Yeah.
And it will at some point, but that doesn't mean that it's going to happen immediately. And so in preparation for this, we sat down and we started to think, okay, if we were to talk about times to make changes to your portfolio, when, how, and what would it even look like to start making changes to your portfolio and your allocations? So you posed the question well, but when should we start to make changes to portfolios? And the first one that we kind of thought of and we're talking about was just if your life changes in some significant way, there might be some change to your financial plan. So life changes, I have a list here, but you guys can add, subtract as much as you'd like. Something like getting married, having a child, changing jobs or retiring, receiving an inheritance, or like moving to a new state. So those are just a few major life changes that would probably or could create a change in your financial plan or your portfolio.
Right. I like that. I also think like this, when you do a financial plan properly and you kind of pair that with your risk tolerance. Mm-hmm. So if somebody comes in and they're moderate aggressive or aggressive, I like to show them the most recent chart of 2022 where the market went down 22% in a 6-month period. Right. And if you're aggressive, moderate aggressive, that's when you go into the market at these spots, that's the type of potential that's out there. But also the story of that is it's recovered well past where that starting point was. And so just a quick 3 years later, it's back well above where it was when it started that little six-month downturn. So if you're aggressive, moderate aggressive, just understand what that means, the risk that you are taking. If you're closer to retirement and you can reduce risk, but also think sometimes we can do a plan and find out that the client only needs to take 5-6%, only needs to make 5 or 6% on their investments. If that's you and you're fully exposed to the market and it falls apart, that's kind of on you. Mm-hmm. You should pare down and diversify so you don't take the brunt of a market.
Mm-hmm. So, and this is a chart that kind of goes along with what you guys are saying, like, not trying to time it, not trying to worry about are we at all-time highs or not, but this is a chart that shows the annualized returns of the S&P 500 if you would have invested at the peak before every pullback, right? So this goes all the way back to the 50s and at different peaks of the market. The average return, if you had invested at the top right before the market sold off, you still would have averaged an annual return of 8.1%. If you had invested at the peak in 2007, you would have averaged an 8% return. If you had invested at the peak of 2020, you would have averaged 12.9. Peak of 2022, the last few years, you still averaged a 9% return. And so,
that proves the point.
Would you have done better if you would have waited? And sure.
One of the things that's a common topic of conversation is how much cash should somebody have? And in my opinion, in working with clients, you should have enough cash that keeps you from making irrational decisions. Whatever it looks like for you to have enough cash that a big life change, a big market shift, something like that happens, it should keep you from making irrational decisions, big changes in a time that you shouldn't be making big changes.
Yep.
So another time that we should that we should look at making changes are if your personal goals change. And this is probably the more gray of the topics. It's not like a hard fast, but goals can look different depending on the year, the month, someone's emotions at that time.
Yeah.
But typically that involves family, it involves being tired at work or being excited about some form of adventure or experience. But as those goals change, trying to pair your portfolio and your financial plan towards that can look a little tricky, but that's when you look at an appropriate time to make a change.
Exactly. I agree with all that. This has been fun, but I think like our experience with clients coming in here to us, it's just more about us making sure they don't make emotional decisions. But that cash question you're talking about, Eli, I have clients that want more cash than others, and it's an answer that they have to determine. And I think that what you just said is the best way to determine what kind of cash you want to have there, keep you from making emotional decisions.
Yeah,
I like that.
And that can change depending on the couple, the career that you're in. If both are working, if one is working, if you're nearing retirement, in retirement, all of that has a variable towards it. Another one is if your portfolio starts to get out of balance. So Matt, you had an example that we talked about before this, but looking at a portfolio, knowing we've set preset guidelines as to how we should manage a portfolio, well, that's going to change and evolve over time. So when or how should you look at rebalancing a portfolio?
Yeah, I mean, there's different approaches, different strategies here, but there's certain clients that we've taken like a bucket strategy approach to. So you've got like your short-term money, mid-term money, and long-term money, and you want to have flexibility. So you want to have that cash, that short-term money. Maybe it's not cash, but it's cash equivalents or safer investment options. You want to have enough in there where you're not having to, sell and replenish that bucket at a bad time, right? You want to give yourself flexibility. And so now that we're at all-time highs, like it's worth asking the question, hey, we're not going to blow up the portfolio. We're not going to do anything crazy, but is now a good time to just carve off some of the gains,
replenish the bucket,
replenish the income bucket, that short-term bucket. And for clients who have already started drawing against that income, that's a good question to ask and something to review. We also have a tool in-house that we use called Nitrogen that helps us score the risk in the portfolio, right? And so you naturally, if the bond portfolio or fixed income portfolio of someone's portfolio is the allocation of their portfolio is not doing as well, and the equities have expanded, like the risk in their portfolio is going to have crept up, right? And so we review that to say, hey, has your risk score crept higher? And now we need to just do a kind of natural, systematic rebalance to get us back in line. We're not trying to time anything. We're not trying to. It's just, hey, the equities have done well. Your risk is a 50. We're now at a 62. We need to rebalance to get that back in line. Those are all things that you kind of agree to and put in place before any of this market stuff happens. You're not doing it, emotionally. It's a system and a process that we have and that we've agreed to with the client that we want to rebalance. And the same is true on the opposite end. If the equity portion goes down and now your risk score is a 40, like depending on your situation, like we should rebalance and take some of the money from the fixed income piece and put it in the equities. And so it goes both ways.
That's so tough. Most people don't want to sell when it's high, and they definitely don't want to buy when it's low. I mean, that's the exact opposite of what you should be.
And that's why it has to be systematic and processed. Like most of our portfolios, we have like a biannual rebalance. We're about to meet on Monday and talk about rebalancing a lot of our ETF models. And so we're halfway through the year, and it's like, hey, it's time to look at rebalances and reallocations for some of our models. And so there has to be a process to it, and you have to stick to it because you're going to want to do a lot of different things at a lot of different times, and 99.9% of the time it's going to be the wrong decision if it's not something that you've decided before the most recent events have happened.
Yeah. I'll say this on a lot of clients that I meet that aren't real necessarily keeping up with the markets, but the market's done really well. And so when you see that, and then their risk tolerance score, a lot of people don't know that. They don't come to see us. They don't know what the risk score is if they haven't done something like that. They just see this wave of greatness, and they just think that's always going to happen.
Right.
And I think there's a great idea inside 401ks, just as we don't really service 401ks, but this is a great time to rebalance the 401ks, right?
Yep.
To your and keep your future allocations aggressive always, and make your current amount of money you have. That's when you can kind of diversify it out to where you should be, if that's more bonds or more safer. This is a great time to kind of rebalance or relook at your 401k and understand your risk tolerance.
Sure.
So
To do what you guys are discussing well, it takes some thought on the front end and then some stick-to-itiveness on the back end.
Yeah.
So you have to, if you're going to have a good investment plan for yourself or for your
stick-to-itiveness is an Oklahoma term.
it is.
Anyway,
It
I
really
like
It
it.
rolled off the tongue pretty well, actually. I was impressed.
Then you have to sit down, come up with, and develop what is right for you. Probably do that with someone who can help you with it, but come up with what is right for you. Then, in the middle of the year, whenever you're freaking out or you're worried, come up with, is now the appropriate time to make a change. And if you can agree, okay, I've already agreed, now is an appropriate time to make a change, then you can make a good decision that's well timed.
Yeah.
But you can also set guidelines around when you shouldn't make changes.
Yeah.
So you shouldn't make changes because of X, and that can look different for everybody. But I think a good investment policy statement, so something that someone develops for themselves, should outline when and how you can make changes.
And on the investment allocation side, the risk and someone's emotions come into it, when we're making those decisions, but also like what is their rate of return need? Like what do they need
Exactly.
to make? There's two main things that drive the market, fear and greed. And those are also the two things that blow most people up.
Yep.
Right? They either get too fearful or things are going well. And so they start thinking, well, I'm more comfortable being a little bit more aggressive than I thought I was when things are going well.
Yeah.
Oh, yeah.
And you have to be honest with yourself. That's nothing but greed.
Yeah.
Like you're getting greedy, you're wanting more, but like you have to do everything. You have to have things in place to keep you in check, because natural human emotions are you're gonna be overly fearful or overly greedy, and that's when people get hurt.
2008 financial crisis, so many people that shouldn't have been fully allocated in stocks were, because of the greed factor.
Yeah.
And a 54% downturn took 65-year-olds that were going to retire and made them continue to work. And that actually happened. Quite a few people. It was not just a one-off. This happened. We haven't had that in that long of time. We haven't had that repeat, and someday we will, unfortunately. Hopefully not, but someday we probably will. But that's what you're talking about. Right now, I see that happening. A lot of greed, not like literal greed.
People
but
like market's done well. People want to
think it's
lean
gonna
into
continue.
that, and it very well may, but you don't need to change how your allocation, your comfort level when it comes to investing because of recent events. Because
Exactly.
the market's done well. It's be greedy, but be greedy within the bounds that you've already set. Don't
Exactly.
get outside of that.
Hey, before we end this podcast, I know we're getting close to the end here. It's 4th of July this week. Isn't that crazy?
It is.
It's one of the best holidays of the year.
We just ordered flags for our front porch.
Nice.
Oh, that's
So
awesome.
We're excited.
I encourage people to do one thing. I'm not going to read this. Don't worry, Matt, because it's long. But if anybody wants to get the best speech I've ever heard in reference to the greatness of America, go back to the 1981 University of Notre Dame speech from Ronald Reagan. It's the best. It is the best speech, and it goes right into 4th of July and what makes America great. I will not read it, but it's fantastic. If you could just Google that speech, there's an excerpt in about how this nation was born, from what our founding fathers, what risk they took, and the money they lost and lives they lost to create this incredible nation. And that's worth reading if you want to go back and look at it. So anyway,
No, that's good stuff. We live in the greatest nation ever.
Doesn't
mean we're perfect. I feel like there's a lot of, never mind. I won't get below.
we're not perfect, but we're the best.
Yeah.
I still think that.
Yeah. Any parting thoughts?
I love America.
Love
This place is
America.
fantastic.
All right.
Canada was nice too, by the way. I mean, it's nothing wrong with
It's
Canada.
fine.
I didn't think we were supposed to like them right now.
I know. I didn't understand. Everything seemed fine up there. It seemed
There
almost
was
like
not
America.
a single plastic straw, and that is a pet peeve of mine.
Plastic. Funny, you're right. There wasn't.
Whenever I drink, I don't want my lips to turn dry.
Yeah. or the straw to start
Like I needed
getting
chapstick
soft.
after drinking a Dr. Pepper.
California and Canada. Anyway, all right.
All right. Well, good conversation. Hopefully this was helpful, making you, reminding you about, having a plan, sticking to it, not reacting emotionally. Market's been great the last month or so, coming off of some volatility to start the year. So it'll be an interesting back half to the year. I'm sure there'll be some things that happen that we have no idea about as
Exactly.
of, today. So as always, we appreciate you guys watching and listening, and give us a like and subscribe. Email us any questions that you have, and we'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.